Sorry, just somebody's obviously just hit record. I was a lawyer in a city law firm, Osborne Clarke, for 8 years and set up the impact investing team in Osborne Clarke. And we advised investors and also recipients of impact investing and social investing. And we acted for some of the largest social impact investors in the UK and also in Germany. I've also been a recipient of impact investing. I ran Auticon for 5 years, which is a reasonably large social enterprise that had social investment from both high net worth individuals and institutions and investment companies. And finally, I also sit on the England Committee of the National Lottery Fund, where we do grants, mainly grant making, but we also do social investment, and we support organizations like School for Social Entrepreneurs and others that distribute social investment to social enterprises in the UK. So I've an amount of experience in advising people on how to make social investment work and how to make impact investment work. This webinar is entirely from the perspective of those seeking impact investment. So if any of you are bored billionaires that are looking for some way to use your vast wealth in a socially impactful way, this might not be the right seminar for you, but please do get in touch with Grant afterwards, because I'm sure he'd have lots and lots of advice for you. But this is, as I say, purely from the perspective of somebody seeking social investment. And what I want to do is just to run through, I'll just share my screen. And Rosie, please let me know if that's not coming up properly on the screen.
Yeah, that's perfect. Great.
I find Zoom screen sharing slightly unpredictable. So what I'd like to do is just start by running through what impact investment is, and then talk a little bit about the different types of impact investment, and also how impact investment differs from other types of purely commercial investment. Then talk a little bit about who is doing impact investment, where the money is coming from, and how the different types of impact investor may view different organizations and what they're looking for. And then finish on how to get your organization ready to go and seek impact investment and what you'll need to do in order to prepare for that. So first thing to address, really just make sure that we're all on the same page, is what is impact investment? First of all, it's an investment, so money coming into a commercial organization. And there are two principal ways in which investors channel money into organizations, and they are debt and equity. Debt is, as it says on the tin, money that comes in that is expected by the investor to be repaid, and interest will be almost always charged on the debt. When organizations, and frequently social enterprises, are small organizations, frequently startups, often debt investment will come with a payment holiday. So when I've had debt investment previously as a social enterprise, the money has come in at the beginning of year one, and repayments haven't started until maybe the end of year one, or even the end of year 2 or 3, to give the organization time to start generating some revenue. It's very difficult to get debt investment unless you've got some assets to secure the debt on, because otherwise the investor will, generally speaking, see it as quite an insecure form of investment. So any social enterprise that is asset-based is likely to be much better able to get debt investment. So there's an awful lot of social investment by way of debt that goes into community centers or city farms, that kind of organization, because there's an asset to secure that on. I think somebody might have a microphone on. I can hear a, that's okay. Thank you very much. Gave me a chance to have some coffee. And the second type of investment is in equity. When investors put money into equity, they put the money into the organization in return for the organization issuing new shares in itself. And that gives the investor an ownership stake in a proportion of the organization. And there will be an amount of negotiation that goes on around what proportion of the organization the investor should own in return for the amount of money that is coming in. And that will be calculated based on what's called the pre-money valuation of the organization. So if the investor thinks that your organization is worth £1 million and they want to own 50% of it, then they would need to put £1 million in to get that 50%. Because after they put the £1 million in, your organization is then worth 2 million because it's got everything it had before, plus it's got the 1 million that's just come in. So you do a calculation that is based on what's called the pre-money and the post-money valuation of the organization to work out a percentage. And that's a little bit subjective. So obviously you can expect some discussion and some negotiation with your investor as to what kind of proportion of the organization that they should get. And frequently investors will feel that entrepreneurs and founders have got quite inflated ideas of the value of their organization before the money comes in, because the founder will want to value the organization on the basis of its proposed and planned future performance, whereas often the investor will be trying to value it on the basis of the existing organization and what's there at the moment. The big advantage of equity investments is there's no interest payable at all. And equity is not repaid by the company. Very, very rare for companies to buy back shares. And it's quite a complex legal exercise to undertake. And a company can't be under an obligation to buy back shares. So you don't have a repayment flowing back from the company. You don't have interest that is payable on the money that's coming in. Generally speaking, there will be no market for the shares. So if you've got shares in British Telecom and you've invested money, so you own a very small, probably proportion of that organization. If you don't want the shares anymore and you'd rather convert them into cash, you can just sell them. There's a free market for those shares. They're listed on the stock exchange and you can look up the price any minute. For a social enterprise, a private company, there won't be a market for the shares. So the investor isn't going to be able to just sell their proportion of the business in order to get their money back. So the way in which they realize the return is on the sale of the full company. There's what's called an exit, and that enables the investor to get their money back, and they'll certainly be hoping for a lot more than that. But it will happen on the sale of the organization. The reasons that investors put money into companies are obviously for a financial return. There are lots and lots of investment funds out there, venture capital funds, hedge funds, investment funds, debt funds, lots of them that do this because they believe that they can choose good and profitable investments and they can make a financial return that is better than they would get on that money by just putting it in the bank and getting the interest on it. So the obvious first motivation for the investment will be financial. The second motivation, and these are the other three motivations that you frequently see for investment, and this is leaving aside the impact side of it, are far more common than people realize. An awful lot of financial investment going into companies at the moment is for more than just a financial return. Lots of investment goes in for technology development, and you'll see that particularly in an area like Oxford, because there's so much technology being spun out of the university. And there are lots and lots of investment funds that circle around a place like Oxford University, looking for new inventions, looking for new technologies, new developments that they can put money in, because ultimately, if that technology is developed successfully, it will be beneficial to their organization. So in addition to financial returns, some investors are looking to see a technology develop. The other thing that organizations will frequently invest with an eye to, and sometimes it's related to the technology, is because they may want to acquire a business in the future. And lots of the big industrial companies, people like Siemens, have got their own venture capital arms that will invest in businesses with a view to acquiring those businesses in the future. They don't want to buy the whole thing now because they don't want to stifle it, and they're not sure if it will all work. But by taking a 25% stake, it gives them an inside track into buying the business in the future. And the third reason that investors often, and particularly the non-institutional, the industrial VCs will invest, is because they think there's a commercially beneficial partner that could be developed via the company that will help their business. And organizations like Apple, for example, invest in an awful lot of technology businesses because they think that these will be good future partners for them that will drive forward their business. And it's important to understand and bear in mind these motivations, because particularly when you're looking for impact investment, it's very easy to think, well, there are two sides to this. There's the financial return and there's the impact return. And I don't need to think about any of the other things. But these things can be very, very powerful motivators for organizations to invest in a business. So it's worth just bearing them in mind alongside the financial and the impact, which is the main thing that we'll be focusing on. But impact investment is obviously different. And the principal differences are around the motivations for the investors. So we've got the financial motivation, which is very clear. And then you may have the other ones that we were just talking about, definitely worth bearing in mind. But impact investment is different. And when organizations, institutions, individuals, we'll come on to the different types of organizations later, when they decide that they want to do impact investing, they will be deciding that because they want a different kind of outcome and a different kind of return. And the different ways in which they'll be approaching it will be, first of all, thinking of it in terms of patient capital. It is well established, and I think generally accepted across the industry, that if you invest in a social enterprise, it is going to take longer to achieve a financial return than if you invest in, say, a software startup, where you might be hoping to see a return within 3 to 5 years, or an exit within 3 to 5 years. It is generally expected that social enterprises will take longer, and therefore impact investors will be familiar with the concept of patient capital, and you will hope will be investing more patiently. It's not always the case, but generally speaking, it is. The second, and probably the most important difference, is that impact investors will be seeking a financial return alongside impact outcomes. So whereas generally speaking, purely financial investors want to get a good exit and they want to achieve a multiple on their money, impact investors want to achieve that, but they also want to see social impact. They want to see the organization deliver on its social objectives and achieve something that is worthwhile within the community or within the sector that it's operating. Generally speaking, impact investors will accept lower rates of return. They will certainly say that they're willing to accept lower rates of return, because they will accept the fact that if you invest looking for impact alongside financial outcomes, you will have to sacrifice some of your financial outcomes. It is slightly more complex than that, in that the way investment funds work is that they need to deliver a return to their investors. So if we look at a typical impact investment fund in the UK, like say Bridges Ventures, they have got lots of people putting money into their fund and they expect a return. Then Bridges Ventures puts its money into social enterprises and expects to achieve that return by investing in social enterprises. What has happened in the last 10, 20 years is that the failure rate for social enterprises has been higher than for other organizations, and the failure rate for social investments has been higher. So to achieve the level of return that people like Bridges need to achieve for their investors, they need their successful investments to be really, really successful. Because if a standard venture capital company is investing in 10 companies and 3 fail and 7 are successful, then they need a certain level of return from those 7 in order to average it out across their whole investment portfolio. If an impact investor is investing in 10 and 5 are successful, then it's going to need a higher level of return from those 5. So although the rate of return across impact investment generally tends to be lower, the expectations of investors from their successful investments can actually be quite high. Impact investors should, and generally speaking, should be looking for balanced outcomes. And the balance between people, profit, and planet is often the way it's phrased. Impact investors are looking for organizations that do good and that behave responsibly, but also achieve a profit. So there's an awful lot more to it, and it's a lot more complex and a lot more nuanced in terms of what is being sought and what's being achieved. Finally, there are a couple of differences to the legal structure, which we can talk about later, in order to just incorporate those additional outcomes and enable that balance of outcomes when you move away from just a purely financial objective. So I want to go through these in just a little bit more detail. The patient capital concept will vary from investor to investor. Generally speaking, you'll see longer terms, but different types of investors may have different perspectives on it. High net worth individuals, for example, tend to invest over longer periods of time than institutions. There's a difference in the way in which funds are set up in Europe than in the US. It's much easier to get longer term funding in the US from institutions. And the reason for that is that funds tend to have a life. So if a rich individual puts money into an investment fund, it will tend to have a life of about 5 years, and they'll expect to get their money back after 5 years. And that's why investors need to achieve an exit, because they've got to pay back their investors. In the United States, it's very easy for investment funds to transfer shares from one fund to the next one in the life of their fund, because they set up fund after fund after fund. In Europe, because of our legal structure, it's far more difficult. So if you look at an organization like Google, for example, it's a very well-known one, there are lots of shareholders in Google that are still the original venture capital funds that put the seed funding in decades ago, and they've just cycled it through various different investment funds. That can't really happen in Europe. So you will, generally speaking, from an institution, they'll be looking for a return within 5 years. You will get a little bit longer from an individual than from an institutional investor, so it will vary, but you should get a little bit longer because you're a social enterprise than from a pure financial investment. The other thing to note when thinking in terms of how patient your capital is going to be is that it may vary across different investors. If you've got more than one investor, then they may have different expectations in terms of when they want to achieve a return. And most organizations may start with one investor, but if you're successful, then you can go out and you can then expand your investor base, which is a very healthy thing to do for any organization. But you do need to bear in mind that if you've got multiple investors and they've all got different expectations in terms of the timing of the exit and the timing of their return, then you will run the risk of conflict between your shareholder base. So it's really important to make sure that you keep communicating with your investors and communicating with your shareholders so that they understand what each other are. They understand their various needs and desires in terms of exit time frame, and so that they're communicating among themselves. So important to understand that may vary, and that it's your responsibility as an organization to try and control that when you have multiple investors and shareholders. You need to have impact outcomes, and you need to build in impact planning before you go and seek impact investment, because otherwise you're just not really going to get anywhere. The investors are going to want to see what impact you're going to have in order to entrust you with their money. It's really important that this is clear at the outset. And I've seen an awful lot of circumstances where organizations and investees and investors have put a lot of time into the financial planning and have thought that they're on the same page in terms of the impact that they're trying to achieve, but then have realized halfway through the relationship that they weren't, that they actually had different views. Because the finances is pretty easy to be objective about. If you say you're going to achieve a profit of X in year 5, then you either achieve it or you don't. But social impact is a little bit more subjective, and it's a little bit more difficult to measure, as many of you will know. So it's really important to spend the time on making sure that you've got clarity with your investors at the outset, and to prepare that before you go and talk to investors. You've also got to make sure that you're on the same page with your impact investors in terms of the balance between impact and profit. And this is a very tricky thing to get right when you've got multiple investors, because different institutions will have different views and different perspectives on how important each of these factors are. But when you go into your first discussions with an impact investor, you need to have in your own mind a clear picture of how you're going to balance impact and profit across the organization. And the final thing to bear in mind is that it's as important to report your impact as it is to report your finances to your investors. And you need to prepare for that and think through how you're going to do that, which means measuring, which means gathering data, and which means collecting qualitative information on the impact that your organization is having. Impact reporting can take resources. It can be tricky. It can be challenging sometimes, but you need to make sure that you've worked out how you're going to do that, what information you're going to gather, and what you're going to report before your investment comes in, so that you can make sure that you're bringing your investor along with you, and that they remain committed to the organization and believing in what you're doing. The rate of return, as I said, may apply to the lower rate of return, may apply to the fund, but not the specific investment. The other thing to bear in mind is that your funder will change over time. And if somebody puts money into your organization with a certain expectation of return, that doesn't mean that that's going to be static over a period of time. So funders go through challenges in terms of profitability and liquidity, and they go through their own pressures from their own investors and their own clients. So don't be surprised if your investor sentiment and your perspective of your investor changes over a period of time. And this is one of the reasons why it's really important to set things out at the outset and make sure that you've got some kind of written agreement in terms of the balance between impact and financial returns, and in terms of the impact that you're going to achieve, because you shouldn't be surprised if 2 years in, your investor starts saying things that are a little different to what they said at the beginning. So really important to have a record of that, but also really important to try and be flexible and to understand the perspective of your investor, that they will have their own pressures. And the final thing to say in terms of the rate of return, it has been very difficult for impact investors to achieve exits in the social enterprise sector. An awful lot of the exits that have been achieved have been in businesses that are much more focused on the profit side and less focused on the impact. And a lot have been achieved in certain sectors, and renewables and clean energy are probably the big area where exits have been achieved, because it's cash generating. But other more community centered social enterprises have proved quite difficult for investors to exit from and quite difficult to sell. So you may find some investor reluctance, and you may find investors appear to be very, very focused on how they're going to get an exit. But do bear in mind that some of that is just because they've seen in their industry that it's not an easy thing to do. Balancing the outcome, again, linked to the previous point, it can be difficult to achieve consensus, but it's extremely important to ensure that you've got clarity on this. A lot of the time, it's seen as being it's seen as being a balancing act, seen as being a trade-off. Increasingly across the investment community, this thinking is being challenged, and investors, not just impact investors, but also responsible investors, are seeing that organizations that are looking after their people, that are looking after the planet, that are behaving responsibly, that are trying to achieve good social outcomes, have got better chances of being profitable, because it attracts customers and business partners, and it attracts better people. So it shouldn't always be seen as a trade-off now. I think it has in the past, but I think that is shifting, and more investors are starting to see that if you've got focus on non-financial outcomes, then you're more likely to achieve those financial outcomes, because you can attract those customers and staff. There are a couple of different things that you need to bear in mind in terms of the legal structures for impact investment. Broadly speaking, it's the same as a pure financial investment. So you'll have an investment agreement. You will issue shares to your new investor. People often think that you sell shares to investors, but you don't. It's almost always done by the creation of new shares, so that it's new money flowing into the organization. So an awful lot of it will be the same. There'll be changes to the constitution, a lot of kind of meetings and documentation. But there are some things that will be different when it's an impact investment. If your organization is set up as a CIC, which is probably the most common form of structure for social enterprises, you need to bear in mind that exits from CICs are restricted. So you cannot sell all the shares in a CIC to a purely commercial organization. The exit needs to be to another CIC or to a charitable organization. So there is a certain element of lock-in. So you'll expect to see some documentation and some other legal structuring put in place in order to set out, if your organization is a CIC, in order to set out how that exit will be achieved and how the investor is going to get the return on their money. It's generally speaking common to lock provisions into the Articles of Association. The Articles is a constitutional document. It sets out how the company is run and what the purpose of the organization is. When organizations make social investments and impact investments, they want to make sure that these things are locked in. So generally speaking, an impact investor will say, we want your social purpose embedded into your articles, and we want to restrict your power to change that. And that gives them the confidence that they have put the money into the business, and it's not going to then pivot or change to being something that is not an impactful business, not socially responsible, or potentially even do something that would be considered to be socially harmful. So because it's an impact investment, you can expect to see slightly different provisions and a little bit more restrictions in terms of your constitution. And the other ways in which the investor will seek to exercise some control over the organization is that you're likely to have a shareholder agreement, and there will be investor consent matters in there. So there will be things that the investor will say, you must contractually not do unless we agree to you doing it. And in purely financial investments, these will be things like changing the director's pay or changing the company's head office, or anything that would impact financially on the business. Whereas if it's an impact investment, you'll expect to see all of that, but you would also expect to see things around changing the manner in which services are delivered, changing the focus of the business, or changing the social impact that the business is trying to achieve. So the next thing I want to talk a little bit about is who invests, who is doing this social investment, and a little bit about how these different types of investors behave and what they're looking for. So the first are social investment funds, and these are some of the bigger ones that are operating in the UK, or some ones that I've particularly got experience of. So Bridges is a very long established impact investment fund in London, and they're seen as a bit of a pioneer. They've grown quite a lot over the past 20, 25 years that they've been running, and they now predominantly invest in relatively large impactful organizations. Ananda is now quite active in the UK. It was originally set up in Germany. And again, it's grown over the last 10 years and now has a small team in the UK, but much more likely to invest in startups than the likes of Bridges. And then you've got organizations that are really focused on particular areas. So Cambridge Associates is an impact investment organization that focuses, understandably, in Cambridge, and that tries to invest in spin-outs coming out of the university that have a social purpose. And then at the other end of the scale, you've got organizations like Lightrock. And Lightrock is an impact investment fund, but it's entirely funded itself by the royal family of Liechtenstein. So it's extremely wealthy. It's got lots and lots of money, and it tends to invest very large amounts into big social enterprises. So there's quite a range in terms of the size and the geographic focus and the sector focus between the different investment funds. And it's really important to do your research and make sure that you understand which ones you're approaching and why you're approaching them, and make sure that you fit with their particular requirements. Generally speaking, and again, I know I say generally speaking a lot, but there's so many different social investment funds, it's difficult to not to generalize in order to say anything meaningful about them. It will generally be equity rather than debt. Usually they're looking for an exit in or around the 5-year mark, but you might be able to, they'd certainly want you to be planning an exit for 5 years. Some of them can certainly be more patient than that, but if you said there's no exit for 10, they're likely to get scared off. And they're generally looking for larger, more scalable businesses. So a lot of the social investment funds will want to not just put money in, but they'll also want to put a director on the board. They'll want to offer expertise, offer guidance, and offer help, because they think that that expertise will help to grow and scale up the business. So for the funds, it's really about getting that growth to increase the value and the relative value of their share of the business, so that they can get that attractive rate of return. And lots of social investment funds will be looking, if they put their money in for a 5-year period, they'll be looking to get back 2 or 3 times what they put in. If it's not going to deliver that, they're not likely to see it as an attractive investment. The social investment funds will, generally speaking, be reluctant to invest in startups. So they're far more likely to invest in an organization that's already had its seed funding from somewhere else, possibly from individual investors, or that's been able to bootstrap to an extent that it's got some revenue and it's got a bit of a proven business model. But they don't tend to invest in pure startups or just something that's just a concept. The second type of organization I want to talk about are the trusts and foundations. And some of the foundations that do make social investment, impact investment in the UK are Esme Fairbairn, who invested in my last company, in Autocon. And they've been going for a very long time now, I think since about the 1930s. They've got quite a substantial fund, and that fund, they then invest to generate a return, and they use that return to invest in other organizations. Esme Fairbairn do lots of grants, but, and this is typical of a kind of trust and foundation, or trust or foundation, is that they do an awful lot of grants, but they'll also do debt funding, and they also do equity funding. So there's quite a mix of stuff going on there. And Joseph Rowntree Foundation are very similar. Similar in terms of origin, single individuals' wealth went into the organization. And then they will look to use the money that they're generating from that original investment in order to achieve social impact. Joseph Rowntree Foundation is very much focused on social equality and focused on poverty, whereas the likes of Esme Fairbairn is far more focused on community organizations. So again, you can see a different kind of, a different area of focus. And the other example I want to talk about is the King's Fund, which is a think tank, really, but it's got a small social investment arm attached, and it does an awful lot around healthcare. And Big Issue Invest is the organization that invests all the surplus generated by Big Issue. And as you would expect, they're very much focused on social enterprises that can address homelessness or try and help people at risk of homelessness. So as with the investment funds, when you look at trusts and foundations, there's quite a mix of different types of organization and also of areas of focus. So as I said, generally speaking, it could be equity or debt, and you'll also get a mix of grants. So as I say, Esme Fairbairn invested in Autocon by way of subscribing for shares and putting debt into the organization, but then during COVID gave the organization a grant. So as an example, we've got one institution has invested in all 3 different ways into a single organization. The foundations are far more likely to invest in startups because they're more impact oriented. And if you can demonstrate that you can generate impact that is within their focus area and within the specific type of outcome that they're trying to achieve, you're far more likely as a startup organization to be able to attract impact investment from a foundation. And then the next kind of organization I want to talk about is there are some what are called arm's length bodies, ALBs. And these are organizations that have been set up effectively by the government, but then spun out of government. So they're not under departmental control of the government, but they get their funding either through government or directed to them by government. And they are in some ways still accountable to government. So Big Society Capital was set up 10 years ago by David Cameron and the Lottery Fund. And Big Society Capital gets an awful lot of its money from dormant accounts. So bank accounts that just haven't been used for decades. And there was legislation passed 10 years ago to enable that money to then be taken out and put to good use. And Big Society Capital implements that. The Lottery Community Fund, where I also work, is obviously best known for its grant-making work, but generally speaking, via third parties, the Community Fund also puts money into, does impact investment into social enterprises, but again, always with a community focus. And Nesta, many of you will be familiar with, the National Endowment for Science, Technology and the Arts, is currently, I believe, the biggest impact investor in the UK. And it has really increased its activity over recent years. And Nesta will invest in any program that is either utilizing or furthering science, technology, and the arts in the UK. And I've seen a lot of investments done by Nesta under its science and technology banner that have been very, very community focused. So people using science, using technology frequently in order to deliver community impact and in order to address inequalities around health, around education. Nesta is quite an interesting funder for those. The arm's length bodies, again, like the foundations, they can invest equity, debt, frequently will also do grants. Will invest over a much longer term because they can have a much longer horizon because of the way that they're funded than foundations or than funds. One of the really nice things about applying to the arm's length bodies is because of that public connection, they've got to be really transparent about what they will fund and who can apply and what their criteria are. So you can go onto the Nesta website and you can really easily find out what they're willing to fund and what they want to see and what they want back, in a way that if you went to the Bridges Ventures website, you wouldn't be able to see. Because it's just not as, they don't need to be as transparent, and they can use their kind of subjective judgment far more. But the arm's length bodies tend to be very, very transparent. And they'll also be very transparent about the assessment process. So they will be open about how they will look at your application for funding and what criteria they will use in order to decide what they will fund and what they will not fund. And the final source of funding I just wanted to briefly touch on is high net worth individuals. And again, when I was running Auticon, we had investment from Richard Branson, which generated an awful lot of interest. Never quite understood why who is investing in your organization generates quite so much interest, but it did. And by high net worth, just mean very rich. And high net worth individuals will I've only ever seen equity investments. I think I can take out the generally there for once, because it's not really about just earning interest on debt. Often individuals will invest in startups and will invest over a much longer term, so it can be very attractive investors. Often there will be a specific area of focus because you're talking about an individual, so an individual will have things that they are passionate about as a person. So Richard Branson is a good example. He's dyslexic and is very, very passionate and committed to neurodiversity. So when we set up Autocon, it was all about neurodiversity. So he was very keen to support the business and make sure that it was successful. Far, far more focused on the outcomes than on financial return. So in a way, very, very attractive investors for your business. The challenge is they're very, very difficult to reach and to approach and to connect to. Far, far more challenging than, for example, the arm's length bodies where it'll be completely transparent. So often reaching high net worth individuals is about networking and about finding out who is committed to the cause that you are, that your organization is going to further. And the final thing, and I just want to spend just a couple of minutes on what you can do, steps that you can take to get investment ready. The first thing, and I'm sure all of you have realized this, you've got to have a business plan. You've got to have a really well thought through business plan. And I have seen a lot of social enterprises take the approach that they don't need to be as rigorous on the business plan because it's social investment and it's all about the social impact. But that's just not really the case. Investors will want to see the same level of diligence and thoroughness in terms of your business plan as they would for any commercial organization. And you need to be prepared to be challenged on your business plan. All investors will kick the tires. They will challenge numbers and they will challenge impact plans to make sure that you've really, really thought them through. Equally, you need to have an impact plan. So it isn't enough to talk about what activities you will do. And impact planning and impact measurement is a whole other area, which we're not going to go into in detail here. But frequently, people talk about what they will do when they talk about impact, but really you've got to show about what that will change, what's going to happen as a result of what you do, what is the impact that you're going to have. And again, be prepared to be challenged on it and be prepared to really stand by and show that you've got something that's very, very robust. And it should be as well thought through as your financial plan. And the next thing you're going to need is an exit strategy. If you ask somebody for money, you've got to tell them how they're going to get it back. Otherwise, they're not going to give it to you. So if somebody is going to invest, how are they going to achieve a return? And what do you expect their return to be? It is your responsibility as the person running the business to demonstrate that you know how you're going to achieve an exit from the business, who it can be sold to, who's going to buy it, how the money is going to flow back to your investor. And you need to demonstrate that there is evidence for this by finding comparators. The first thing to do in looking at impact investment is to find an organization that is as similar to yours as you can find, that has exited, that has had somebody invest in it and make a good return. Because that is going to be a very, very powerful argument for any impact investor if they can see it's worked in the past. So make sure that you do your research. And as I said, be prepared to be challenged on the financial and the impact plans, be prepared to be challenged a lot on this, because this is the most important thing for any impact investor. It's easy to get the money in. They're going to need to understand how the money is going to come back out to them. And I've seen this mistake made countless times. When organizations need investment, they see getting the investment as the journey, which ends with the money flowing into their organization. And it's really easy to get transfixed on that when this is your life, when you need the money to fund the organization that you believe passionately in. But you've got to change your mindset, and you've got to put yourself in the shoes of the investor and start thinking the way they will be thinking, that the money coming into your organization is the start of the journey. That is where things start. It is not the end point. And you've got to think about, if that's the start of the journey, how is that journey going to look for the investor? What risks are they going to see? And try and preempt those risks and seek to mitigate them and demonstrate how you can mitigate those risks. But don't fall into the trap of thinking that getting the money into my business is the end point, because if the investor sees that in your thinking and your attitude, it'll be very, very off-putting for them. They will want to see you talking about that as being the start point of a journey together. And the final thing, and virtually every impact investor will tell you this, that they invest in teams more than they invest in plans. And the reason that you invest in a team and not a plan is that if the plan goes wrong, but you've got a really strong team, you can fix it and you can get it back on track. But if the team isn't strong, then you can't just rely on the plan. So make sure that it is not, they don't just see a founder, make sure that they see as much of your team as they can, and make sure that your commitment comes across as really, really strong. Also, they'll want to see that you're not only realistic about your goals, but that you welcome challenge and that you welcome being challenged on your assumptions and what you're planning to do. And if you can bring that attitude to your discussions with impact investors, you're far more likely to get a good hearing from them. On that point, and to the relief of everybody concerned, I will stop talking. But we do have a few minutes left, so I just wanted to stop talking a few minutes early and just give a chance for anybody to ask any questions that you may have.
Thanks, Ray.
Right up.
Brilliant.
Oh, sorry.
And so sorry, Grant. Grant, did you have a question?
Well, actually, I was just going to point. I got a direct message from someone, so there is a question coming. But do you want to just do that a little bit of rounding up first, Rosie, or are you happy for me to just jump in?
Go for it. Go for it.
Okay, yeah. So, Peter, would you like to ask your question personally, because you might be able to give some context? Is that a no? It came off mute and it went back on again.
Okay.
Go, Peter, we can hear you.
Hello, thank you. I'm struggling with the camera, but you don't need to see me. All that was excellent, very good, and thank you. Made copious notes. My question really is at the basis of the security that either a grant funder or an investor would see. Bricks and mortar are obvious. Can you make some comment about intellectual property, software and content? Is that regarded as safe, secure?
It's a good question. And unfortunately, the answer is it depends. If you've got some code that has been developed and you can show, and it's really important that you can show the ownership of the code. So you'd need to have the records, and you'd need to have the kind of GitHub repositories, all of that kind of stuff, in order to demonstrate that your employees developed the code, or you did yourself, and that you've got a transfer of the intellectual property rights. In the case of code, it's copyright in that code to the organization, either by an employment contract or something else. Then you do potentially have an asset that you can look to secure on. It's not the same as getting a security over bricks and mortar, where an investor would seek a separate security over that asset registered with the land registry. What an investor would do is he would take out what's called a fixed and floating all monies charge, which means they get security over all of the assets of the business, which would include the code. So from a legal perspective, it's definitely doable, provided you can put all those blocks in place. The challenge is going to be in valuing it. And there's some code, is pretty easy to value. I've seen lots of investments in computer games and that kind of stuff where you've got huge revenue streams or revenue potential, and you can put a good value on that. If you've got code that's been written and not commercialized, it could be difficult to convince somebody of the value of that, because the vast majority of code that is written is never effectively commercialized. It's just wasted. So investors will be aware of that. But if you can demonstrate and convince somebody of the value of it, then, and the ownership, then there's absolutely no reason that can't be used as security for debt funding.
That's good. Very, very, very helpful. Thank you.
There is a question from Diane on tips on how to attract investors. I'm not sure I'm not sure.
$1 million question.
No, I don't think it's the right question.
Well, I'm sort of talking really from a marketing and PR perspective. So I'm here on behalf of the Oxfordshire Community Land Trust. So our share offer has already been launched, and in the first week it was really successful. We've had a little bit of PR coverage, but it's kind of hit a brick wall. So we're just trying to have a bit of a brain sort of stall moment and pick up some ideas on how are people reaching these investors? How are the investors finding out about investment opportunities? Is it purely through social media and tagging, and just, in terms of contacting PR, do you just do it once, and if they don't bite, you leave it, or do we do it regularly? How often should you contact PR? It's all these kind of things that and we're just throwing around in our minds.
Are you seeking to attract individual investors?
Individuals or businesses. So the investment opportunity is from a minimum of £250. So obviously that would be looking at targeting individuals up to 30,000. So that would be small businesses.
Okay. So the reason I said it might not be the right question, is that if you're talking about institutional investors, you need to go to them.
Yeah.
You're not going to be able to attract them to you. Institutional investors don't kind of scour the landscape looking for investments to make.
No, well, that's an interesting observation. We didn't realise.
They just don't. What they do is they slog their way through their inbox because people are approaching them. So I think for the if you want to attract institutions, you're going to have to go to them individually and say, we think this is the right investment for you because you have said you're interested in all of these things, and we tick all of your boxes. So, and that's, you can't do that for 250 quid because it'll kill you in terms of the workload for the return.
Yeah.
But if somebody, if there's somebody who could potentially invest £30,000, the only way you're going to get them to do it is to put the time and the effort in to identify them and do a bespoke approach to them, explaining why this is right for them as an individual investor.
How do I identify them? How do we find them?
You could look at
I've done Google. I've put keywords in, and I've found other companies who list who their investors are. So we've sent.
It's all of it's all of that kind of thing that you. I mean, there are. I'm sure there are directories of investment funds. But finding them, it's really a case of just researching and just slogging your way through them and finding
out about them, and actually then tailoring it to them. Exactly. Not one blanket press release fits all.
That won't work.
On that last point about directories, Rosie, I don't know if you know, but for those on the call that aren't aware, the BIPC, which is the something or other British IP Centre in Oxford, in the Westgate Centre, in the library, do have a series of databases which usually you subscribe for. So, for instance, it's Grant Finder. Now, I know you're not talking about grants, you're talking about investment, but I just wondered, that might be worth talking to them. They might have access to investors as well as the grants. I'm not sure.
Okay, thank you. It's a good tip. Thank you.
Yeah, and I would also just say on the kind of PR front that it's worth just keep going with it, because like investors, journalists and PRs have got hundreds of emails coming in every day. So It's just
It might just be that they've literally missed it, got them at the wrong time. Yeah.
so
Okay.
I
Equally, I don't want us to come across as a nuisance. So that was why I was just trying to understand what.
No, you need to be the squeaky wheel.
Right, fine.
Yeah, embrace your inner nuisance.
Okay, I can do that.
The other, in terms of attracting individual investors, have you talked to ethics?
Yes, they're actually supporting. Yeah, they are doing it on our
Okay,
behalf. So
yeah.
yeah, so they've got some good contacts themselves. But as I say, it's because we've hit this brick wall. There's only so much social media stuff we can push out. You know, we're getting the same support and likes and retweets from the same people. So it's just trying to find other ways to reach the right people. And I'm interested that you mentioned Richard Branson, funnily enough. So I know it's only £30,000. It's like a fiver to him, hopefully. But you know, his old house where his daughter lives is like a cycle ride down from my house. So you know, he's Oxfordshire invested. He lived here, so I'm thinking he might be a great person just to chuck in a few quid. Who knows?
Yeah, if you're I would maybe contact Holly rather than Richard.
Okay.
She's been trying to get much more active in social investing.
Oh, okay.
And locally, I think, Ray, as well, isn't she? She's
Yeah.
quite active locally, yeah.
Yeah, she's literally just down the road, right?
That's right, yeah. The other question, Diane, as well, so interestingly, because we saw Fran and some of your colleagues last week at one of our events, but
oh, okay, yeah.
I was catching up with her, but what about the relationship with the Community Foundation? I know it's not the same, but they have, and it might be detracting from what they're trying to achieve, but they have good connections with high net worth people as well. So I don't know if it might be, they've got a new chief exec now as well.
Who was that, sorry?
This is the Oxfordshire Community Foundation.
Yeah.
OCF, yeah.
Yeah.
Because obviously they're there to support lots of local issues.
Yeah.
And what you're doing is definitely addressing that sort of affordable housing issue. So quite whether they want to sort of point the people that give them money to you, I don't know, but certainly
well, we do engage with them, and we do mention them through our social media and things, so they're aware that we exist.
Yeah.
So but perhaps we can ask them to do a little bit more for us. So thank you.
Brilliant. Thank you so much. I'm just conscious of time, so I think we will have to leave it there. I will send out a follow-up email, so you can always send your questions on to me, and I can always forward them on to Ray or Grant after the session. But thank you so much for joining. Thank you so much, Ray. That was brilliant, really informative.
Thank you all for joining. I appreciate it.
Rob's just put a very helpful link in, Diane. You might.
I'm on it. I'm on it. I'm good.
Oh,
I'm on it.
Rosie will share that anyway. Thanks, Rob, for that. Thanks. Yeah. Cheers. And Rosie will share that with everyone.
Cheers. Thank you.
Thank you so much, everyone. Have a good afternoon.
Thanks. Bye.
Thanks all.